Taking your finances seriously often feels like standing at the bottom of a dark ravine, staring up at an impossibly high peak. You're carrying a relentless burden of bills and obligations, and the distance between where you are and where you want to be feels abstract and entirely out of reach. Standard financial advice usually ignores this feeling. It assumes you operate perfectly, like a machine running lines of code designed to ruthlessly optimize a spreadsheet. But personal finance is deeply behavioral. The milestones that actually change your life and keep you moving forward are emotional, not mathematical. You face a strict choice right now. Do you put your limited cash toward maximizing compound interest, or do you use it to buy yourself some immediate peace of mind? This table illustrates the conflict. On the left, the mathematically perfect strategy demands maximum returns. On the right, the human element prioritizes behavioral momentum. Forcing yourself down the left column often ends in disaster. Mentally exhausted, you abandon the plan entirely. Instead of chasing percentages blindly, we need to restructure your goals into the wealth hierarchy, a 3-phase roadmap based entirely on what your brain requires to keep going. This 3-tiered pyramid shows that roadmap, starting with the base foundation, survival mode. At this level, you funnel every spare dollar into 2 strict targets: clearing high-interest debt like student loans, and stacking a firm $20,000 cash buffer. Reaching those targets eliminates the background anxiety that stalks your everyday decisions. When a mechanic says you need new brakes or an unexpected medical bill arrives, it doesn't wreck your life. You just shrug and pay it. Escaping survival mode provides a massive physical relief. It feels exactly like a heavy, rusted anchor snapping off your neck and dropping into the ocean. To get that relief, you make a mathematically poor decision. This quadrant chart plots phase 1 here: high emotional impact, low mathematical optimization. Holding cash instead of investing means missing compound interest. That lost gain is the price for emotional weightlessness. Prioritizing your peace of mind over future wealth in phase 1 is the required fuel. It proves to yourself that you have control, which keeps you from quitting before the real work begins. Once you are secure on the ground, we move to the middle tier of the pyramid, the momentum phase. Here, the focus shifts to establishing mathematical velocity. You automate your investments, max out your employer matches, and grind toward a $100,000 net worth. That first $100,000 takes a grueling amount of time and severe lifestyle deflation. This timeline chart shows the snowball effect in action. Getting to that first milestone takes 10 years. But then intervals shrink rapidly. 5 years, then 3, then 2. As this compound interest curve overtakes your savings rate, your capital begins earning returns on its own returns. The psychological shift is profound. You spend a decade feeling like you are pushing a massive boulder up a steep hill, and suddenly you are watching a snowball roll down the other side on its own. The trade-off here is explicit. You must delay your gratification. You trade away short-term lifestyle inflation and visible progress today to build an unstoppable financial engine for tomorrow. Phase 2 demands that you lock in your discipline for a solid 10 years to secure your escape velocity from the daily grind. When your money starts working harder than you do, you enter the apex of the pyramid, the freedom dividend. At this stage, you have the capital to aggressively pay off your primary property and fire your financial advisor. In this phase, your investments outpace your living expenses. You achieve total autonomy because you no longer rely on an employer to survive. Instead of carefully monitoring your boss's mood to see if you can ask for a raise or take time off, you watch global markets with a vague, comfortable detachment. Hitting $1 million net worth at this stage isn't about buying luxury items. It gives you the ability to buy back your time and help your family out without sharing the stress of your financial burdens. This stage also allows you to make a highly controversial choice. This line graph compares the exponential growth of money invested in the stock market against the flat line of dumping your capital into a paid-off home. The gap shows a massive loss in potential wealth, but paying off your property is the ultimate victory. You trade theoretical market gains for untouchable downside protection. Nobody can ever take away your shelter. Phase 3 proves that the ultimate purpose of accumulating wealth is to transition out of making money and into buying absolute sovereignty over your own life. To get there, you need to stop measuring your progress against the arbitrary cultural goals you see online. you need to identify your exact position in this hierarchy. Let's map your next move. This decision tree starts with the most critical central question. Are you drowning in monthly payments with zero cash buffer to protect you? If the answer is yes, you are a beginner in phase 1. You must ignore complex investing strategies entirely and strictly target emotional relief. If your buffer is secure, we follow the path to the next question. Is your net worth still sitting under $100,000? If yes, you are an optimizer. Do not get distracted by a low-interest mortgage yet. Focus ruthlessly on hitting that 6-figure mark to activate your compound momentum. And if you are nearing $500,000, you follow the final path. Stop optimizing every single spreadsheet cell and start utilizing phase 3 to buy back your time and lock in your absolute security. A perfectly optimized plan that causes so much stress you abandon it is useless. An imperfect plan you actually stick with will change your life. Look at where you stand today and confidently choose the single financial milestone that buys you the most psychological control.